Hello guys, welcome to another educational video, and today we'll be discussing about a topic called open interest and how we use it for analysis and how we can implement it into our trading strategy and use it effectively for in volatile markets towards expiry, mainly during expiry. So keep this in mind that option open interest analysis will be used when the markets are close to expiry. So expiry, as you know, is the weekly expiries are on Thursdays of every week. So today was an expiry, today is a Thursday. So expiries of every week, when you come close to the expiry, so let's say Tuesday or Wednesday, and this is when you start your open interest, start reading your open interest charts. So what is an open interest? So open interest is the number of option contracts which are active in the market currently. So as you know, there are two types of options: call option and put option, right? So there is option or open interest for call options as well as put option. So what is this open interest? So call option, when one buyer buys a call option from a seller. So the seller is selling this call option to the buyer, right? So one contract is written basically when this transaction takes place. So when this one contract is written or one contract is bought, it's the same contract, one single contract. This contract becomes active in the market, right? So this increases the open interest in the contract by one. So open interest, as the word itself denotes, it is the number of open contracts in the market. So if there is one buyer and one seller, there is one contract written, so open interest is one. Similarly for put option, same thing. Open interest will be one when one buyer buys a put option from a seller, right? So this is what is open interest. Now how do we analyze open interest? Now as I told you, in call option, one buyer is buying the call option from the seller, right? So what are their perspectives? So the buyer is buying the call option because he is bullish on the market and he thinks prices will increase. Seller is selling the call option because he's bearish on the market and he thinks prices will decrease. This is the basic thought process when the call option is activated. Buyer thinks prices will go up, seller thinks prices will come down. Same thing for put option, but just the opposite, right? So buyer again buys the put option from the seller. The buyer thinks prices will decrease, whereas the seller thinks prices will increase, because this is for the put option. So this is the basic fundamental of how options work. Now what do we know from a buyer and a seller, from an option buyer and an option seller? We know that an option buyer is most probably a retail investor with less capital, because option buying, as you can see here, if I want to buy this option, margin required is 20,000. But if I want to sell this very same option, margin required is 1.5 lakhs. So clearly the buyer is smaller than the seller in terms of capital and money. The seller who pays up high margin has more at stake. So the sellers are generally big institutions and individuals with high capitals. So the sellers have more at stake than the buyers. The buyers have a maximum of 15,000 which they're paying. They cannot lose more. The sellers, after paying 1.5 lakhs also, there is a scope of them losing even more than that. So that is why the seller in the market is considered to be at a higher position, and he has more control over the market, right? So whenever we read option interest data, we always read this data from the perspective of the seller. So if there are a high number of calls, if the option interest, if the open interest in a call option is very high, right? If the call option open interest is very high, we will say that prices are most likely to either go down or stay sideways. There is a very less probability of prices going up, because there are a lot of call options being written by the sellers at this area, which means there are many sellers who think prices will not rise up. Now because these sellers have more at stake, we will assume that these guys are the ones who are right and not the buyers. Same thing for put option. If the open interest in a put option is very high, we say that markets will not fall down below that level. So how do you read this? So for option open interest, you can just Google Nifty open interest and you will get the NSE website's open interest form. So the calls are on the left and the puts are on the right. So your main columns will be this OI open interest, the extreme left column, and this OI on the extreme right. Now as I scroll down, these are negligible open interest, we won't consider all this, but as we scroll down, these increase as we move closer to the strike price. So our Nifty level currently is 14,867. So that's around these levels. Now if you see, my call option open interest will start increasing from here, right? So let's take the highest call option open interest. So my highest call option open interest is this. At 15,000 strike price, the open interest is 73,000 almost, which is the highest open interest in all of these. So what does this imply? So this implies that there are a lot of call option writers at 15,000 and markets will most likely not go above 15,000. So this means that 15,000 will act. So this means that 15,000 will act as a strong resistance. Right, I'm denoting this by R. Now let us look at put options. Now for put option open interest, if we find the column with the highest put option open interest, I think 14,000 is the one, right? So 14,000, there are lots of put option writers. Since the open interest here is the highest, we will say that the 14,000 put option has a lot of option writers, which means a lot of put option sellers think that markets will not fall below 14,000 for the coming expiry. So this is the expiry date of 1st April, so today itself. So data might be not be the most accurate, but still it is accurate to an extent. So 14,000, there are a lot of put option writers. So this means at my 14,000 will act as my support. So markets are most likely to stay between 14,000 and 15,000. So this is what is derived from this open interest data, option chain data, right? Now we have identified the highest open interest and lowest open interest. That is fine, but that doesn't mean everything else, all these other open interests are negligible, right? We can't ignore them as well. So we look at these open interests in which open interest is considerably high. So we can see that for 14,800 and 14,850, the open interest inputs are high. So even these would act as good supports for us. I will write them in the chart again. Let's say 14,800 is also a good support. So 14,800 is also a support for me. Now on the call side, if I see this 15,000 is the highest. Now if I see the second and third highest, I will see that 14,900 is also high and 15,100 is also high. So I will write 14,900 and 15,100 will act as resistances for me. So I have taken the top three on both sides. Now this is open to interpretation, and you can experiment with these. You can take 4, 5, 6, how many ever you wish to, but I have taken 3 resistances and 2 supports, right? Now if I will go to the daily chart, and let's say I did not have this candle before, right? This is today's candle formed. I will go into this rewind mode. Yes. So this was yesterday's candle for me, and I have identified, what have I identified? I have identified that 14th. I don't think I can go into the smaller charts. Identified my supports as 14,800 and 14,000, right? So let me draw these on the chart. So my 14,800 is here, and 14,000 is all the way down. So these were my two put options with the highest open interest. Now for my resistances, it's 14,900, 15,000 and 15,100. So 14,900 is here, 15,000 is here, 15,100 is here. I will make these three lines red to denote that they are a resistance. So green means they are supports and red means they are resistances, right? So now if I observe, so I did not have this data, so this was the data I had, right? So on doing my open interest analysis yesterday, what would I conclude? That 14,800 there is heavy put option writing, 14,000 also there is heavy put option writing, and I have call option writing at 14,900, 15,000 and 15,100. So market is most likely to expire between this range, below the resistances and above the supports. So this is where markets will most likely expire. Not open, but expire. They will close tomorrow mostly in this range. And what happened today? You can see that markets clearly expired between this and below these resistances and above these supports. Markets fell down, but in the end again buying came, and then the put option. Suppose markets closed here itself, the huge open interest at put options which was there at 14,900 or 14,800. 14,800. So these put option sellers would be losing a lot of money. So what we can interpret from this is these put option sellers, these very same guys, got the market up. Now these are the option writers are guys with huge capital. They are institutions. So they run the market basically. So they have the power to do this on their own, right? So what we would interpret it as, these put option writers were in losses, so they got the markets up and made sure they didn't end up in losses. At the end of the day, the market expired where they wanted it to. So this is how open interest analysis is done. So you identify the strike prices with the highest open interest in call side and put side. You mark your supports and resistances. All this is done 1 or 2 days before your expiry. You cannot do this 1 week before expiry or 1 month before expiry, because that won't give you accurate results. You'll get accurate results when you do this closer to expiry. So expiry is on Thursday, you can do this on Wednesdays and Tuesdays, right? So you can mark your supports, you can mark your resistances, and you can basically predict where the market is most likely to close. Now again, remember, I'm using the word most likely. There is no guarantee that market will close there, but this is most likely, and this is what has been observed in the past, that the option writers make sure they don't end up in losses because they have more at stake. So that's it for today, guys. Hope you learned something from this, and thank you.